Meantime, it has been a busy week with Canadian banks reporting results, and one of the standouts is Scotiabank. Scotia's results better than expected, in part thanks to a solid showing from its Canadian business, and investors definitely took note. Now, keep in mind, the Canadian growth is part of a plan CEO Scott Thomson put in place when he stepped into the chief executive role in 2023, and Scott joins us in studio to talk more about the Scotia strategy. Good to see you. Thanks for joining us.
Nice to see you, John.
You know, we've spoken a few times since you became CEO. It was notable that with these results, the market really responded. What's your take?
Well, we're 7 quarters into a long-term strategy repositioning of the business, and this was a quarter where all of the business lines contributed to what was both good top line and good, bottom line results. And so, a huge credit to all of the Scotiabankers across the global footprint that contributed to that, and thank you from me and from the board to all of their efforts.
You've been talking about something called value over volume, a philosophy that seems to be rooted in just a better focus on the customer. Can you walk us through that strategy?
Yeah, I think historically we had been a big lender with monoline clients where we deployed balance sheet but didn't necessarily deploy the rest of our capabilities to help the client be successful. And so one of the things that we're trying to do here is just make sure that we are deploying capital to the right clients where we can help them. And this volume versus value discussion that we're having is obviously having a good outcome for return on equity. And so if I look at 2 business lines in particular, one would be our international bank, where we've actually reduced the capital in that business, but you've seen significant improvements in net income growth and return on equity growth. And then similarly in our GBM business, we've seen actually lower capital deployed, but significantly higher revenue and net income. In fact, in this quarter, we saw balance sheet down 14%, yet profit up 29%. And a lot about that is about the products and capabilities that we're building that we can then deploy to our clients and help them beyond just the balance sheet. Obviously, the balance sheet's important, and we're going to continue to deploy balance sheet, but we want to provide capabilities beyond the balance sheet that can help our clients.
The other thing I noticed you talking about was more cooperation across the bank. So take the cooperation between the banking team and the wealth team. Can you walk us through how building a better bridge there serves the customer in the way that you seem to be really focused on?
Yeah, one of the things that we're trying to do from a cultural perspective is just make sure that the client is the center of everything, and then bring the organization, the enterprise, to the client. And so wealth and the coordination between wealth and our Canadian bank is a perfect example. This quarter, you've seen significant referrals between our wealth and commercial business and our wealth and retail business, which has helped both businesses prosper and also help the client. So our wealth business this quarter had significant net income growth, but what was really encouraging was the net fund flow. So obviously the markets do well, and we all do well when markets are doing well. But in this quarter, year over year, you saw an $11 billion fund inflow change year over year in our wealth business, which is really significant. And a big part of that is because of the coordination between our Canadian bank, both on the retail side and the commercial side.
Well, and sure, the markets have been hot, but Canadians are also wondering about uncertainty in trade. And I would imagine that if there's a better transfer from your trusted, bank to the wealth arm of that bank in an environment like that, that would help too.
Well, this is the great thing. We've been on this journey for the wealth business for the last 10 years. It's our fastest growing business. And right now in this quarter, we had all-time high client satisfaction results from our clients. And so you're right, in an uncertain world, you need advice. And what our wealth channel is showing, what our wealth advisors are showing, is that it's really resonating with the clients, and then we're doing well by the clients, and they're more successful in what they're trying to achieve.
So obviously there's been a pretty strong focus on Canada. This remains a cross-border business, a business with exposure across North America. The tariff environment is one we're still navigating as well. So how are you navigating that part of it?
Yeah, control what you can, right? And so what we're saying to our teams is control your costs. And control your capital, and make sure that you're operating in a disciplined fashion. And that's why I really did like the expense discipline in the quarter. But what I am confident about is because of the diversification of the platform and because what we've done over the last 2 years has been so successful, we are now setting the foundation to grow in these international countries that we operate. And then long term, I do think there's strategic rationale to Canada, US, Mexico. I think under our new Prime Minister, some of the things that he's doing with the Mexican president and the US president are going to bear fruit. And I'm hopeful that we are going to see a renegotiation of the USMCA, which will be really positive for our clients and how we're positioned across that footprint.
Now, when it comes to the operational performance, I would imagine that then opens the door for a nice question to be dealing with, which is how you're allocating capital, including with shareholder-friendly things, stock buybacks, and the like. How are you thinking about that?
Well, it's all connected back to your volume versus value. If you optimize the balance sheet and really focus in a disciplined fashion on deploying capital to primary clients, who then bring deposits with them, you actually need less funding, which allows the balance sheet to be stronger. And you've seen massive improvements in our wholesale funding and our cost of funds over the last 2 or 3 years, which then allows you to have a really strong balance sheet and creates extra capacity then to deploy capital to shareholders. And so in this last quarter, we were very active on our share repurchase. We'll continue to be active in the fourth quarter. And what we've done over the last 2 years is build up a significant fortress balance sheet for the company. We've gone from 11% capital to 13.3% capital, and we've built over $2 billion of ACL protection for the bank. So we're running with a fortress balance sheet and the opportunity then to deploy capital in shareholder-friendly things like share repurchases.
That's helpful context. And, a theme for banks, broadly speaking, in earnings season, provisions for credit losses. I think sort of the most feared scenarios, let's say, amongst analysts did not materialize. Maybe that's because the worries we might have had about the economy 3 or 4 months ago haven't necessarily materialized that way. But sort of how are you thinking about how your bank provisions?
Yeah, last quarter, we took a pretty significant performing build to protect against any eventuality. You're right. I think there's a little bit of a different tone, probably cautious optimism around what may transpire here over the next year or so. And what seems like it's becoming a theme through reporting season is better performance on impaired loans. And so you saw our impaired loan performance improve pretty significantly year over year. As we move forward, we're still trying to be cautiously optimistic, but also conservative. And there are some strains in the economy that we have to be thoughtful about. And then obviously what happens here with tariffs and renegotiation of the USMCA is going to be important.
So at the end of the day, is it starting to feel like a turning point for you with the strategy a couple of years in here?
Listen, I think we're early. We're 7 quarters into a long-term journey. I'm really pleased with what we've done on the balance sheet side. I'm really pleased with what we've done on the cost side. I'm really pleased with the return profile, but we've got to continue to see improvement particularly on our retail businesses in Canada and international. This quarter, there were some green shoots. We saw deposits, cash and savings deposits up 6%. We've seen $50 billion of incremental deposits since we started this journey. We've still got to have the discussion around expense and efficiency in some of our businesses, but I'm pleased with the momentum we're having. I think 2026 is going to be a great year for the bank.
All right. Well, Scott, you talked about some of the trade things to watch for as well. There's some big macro questions, including for the Canadian economy. We want to take a pause, come back, talk with you a little bit more about Scott Thomson's views on that. Stay with us here on Morning Markets. One of the takeaways from Canadian bank earnings this week seems to be that the economy is showing signs of resilience, and yet everything from trade uncertainty to AI disruption are inviting a broader dialogue around how Canada can be best positioned for the long term. We wanted to get some perspective on that from the head of one of the country's leading banks, Scott Thomson, is CEO of Scotiabank. He's back with us now. In terms of the state of the economy, where we're at, what's your general view?
Yeah, I'm feeling cautiously optimistic. I mean, I do think with the new government in place, Prime Minister Carney, Minister Hodgson, Michael Sabia, I've had time spent with all of those individuals through my career. They're very smart, they're very capable, they're thinking about Canada, and they're trying to move the agenda forward. And so when you think about opportunities through Bill C-5, I do think those are going to start to come to fruition, and I think we're going to be better off for it long term. It's been a little bit of a bumpy ride because you've had the uncertainty of what's gone on in Liberation Day. But I'm feeling better than 6 months ago for sure, but we're not through the woods yet in terms of credit performance, et cetera.
I mean, you talked about some leaders who have business backgrounds and some of what they have said, obviously in terms of being successful on an economic front over the long term makes a lot of sense. What's your sense of what is needed, though, from leaders to battle through bureaucracy, which I have heard on occasion as people have been talking about these bold plans?
Well, and this is what I think the great thing about Bill C-5 is that we did as a country get bogged down in this permitting and regulatory morass that just didn't allow things to get done. And so what the government has done here is identifying projects, making sure they're highlighted as national importance and drive them forward. And look no further than LNG, right? I mean, you think about the LNG conversation that we've been having as a country, and back to 2022 when, Germany came here and asked for our LNG.
True,
and
yeah.
we said there was no business case for that. And you turn that around to yesterday, where you've got our Prime Minister and the Minister of Natural Resources actually in Germany talking about LNG. And we're talking as a country about getting phase 2 up and running off the west coast of Canada. And so those types of things are actually the enablers to the growth that we need as a country.
What's remarkable is you've got all that happening at the same time that we are watching the AI revolution. There's so many layers to it. There's, as a business leader, how you're implementing it into your business. You've talked about how that's, also a key strategy as well. But we're also trying to figure out how AI influences, changes our economy. There's no answers necessarily that we'll know on how that will ultimately change. But what do you think?
Well, a couple things. AI is obviously going to be important for businesses. And so I think about it a couple of ways. Think about Canada is actually well placed for that, both from the AI talent we have in the country, but also data centers and natural resources that are going to be required to build those data centers. As a country, we're actually well placed. As a company, we're also well placed as you think about some of the applications for AI that are going to be really important. And I think no further than customer service centers, for example.
Yeah.
We've deployed AI capabilities to our frontline staff to help them with their clients. We've also deployed it to our staff to help them internally with questions and navigating problems that they might have. So I think it's ultimately going to end up in a better client experience and actually a more efficient cost structure across businesses. So AI is going to be important. We have to make sure as a country we're on the leading edge of this, but I do think we're well placed for that right now.
Okay, so I guess at the end of the day, on this bigger subject of nation building, this nation building moment, it sounds like you are encouraged that we can deliver on that.
I am. I mean, I've been consistent on this since Liberation Day. I think this was what was needed a little bit for Canada, was a recognition that we weren't getting things done. Our productivity was falling behind. And to see Prime Minister Carney come in with a very bold agenda and start to harness the resources to get things done, I think is really encouraging. And I would say as a Western Canadian, I've spent a lot of time out in BC, Alberta, Saskatchewan. I think there's cautious optimism there as well that we can get some of these resource projects done over the finish line to both strengthen with the U.S., but also diversify our trade with other countries, which is essential as well.
Absolutely. Scott, thanks very much for the time today. We really appreciate it.
Great. Thanks, John.
Scott Thomson is the CEO of Scotiabank.